Hi everybody, this is a video for my grade 12 essential math students, and today we're going to be looking at lesson 6 in your home finance booklet called Home Insurance. And I always assume that everybody who's done this course has actually done either the grade 10 or the grade 11 essential math, but I know that's actually not everybody. So just in case you're not quite sure even what the concept of insurance is, or you know sort of what it is, remember that the definition of the word insurance is that it's there to protect you from financial loss, right? You have automobile insurance because it would be a financial loss for you if you got into an accident and then you had to pay to fix your car. Or if you caused an accident and that caused somebody to get hurt and they wanted to sue you to compensate them for their injuries and their damage, and that would be a financial loss to you. So your auto insurance protects you from all those things. Well, home insurance protects you from financial losses that might happen to your home. Before we get into houses and homes, though, remember that anybody who rents an apartment, or they don't actually own the property they live on, they just pay rent. Renters, the word for renters is sometimes called tenants. And tenants package policies, if you live in an apartment building or you live somewhere where you rent but you don't own, you can still get insurance to cover and protect you from the financial loss of losing your possessions, your property that you have within the place that you are renting. For example, Joe rents an apartment. He calculates that the value of his clothes, his stereo, his furniture, and other possessions is $25,000. He wants to buy a tenant's package policy with a $200 deductible to protect against financial loss in the event of a robbery. Now, robbery isn't the only thing that could happen to the insurance or to the possessions that are in Joe's apartment. Say the apartment building burns down, right? The people who own the building are going to have insurance to replace their building to protect them from the financial loss, but you don't own the building, and those people that own the building don't own your possessions. So that's why you need your own insurance. Robbery, however, is of course the number one way that people lose their possessions in an apartment. So that's the main one that we're going to talk about. So he's going to choose something called a comprehensive plan. We'll do the actual math on this answer, and then we'll talk about what that means, a comprehensive plan. And to do the math, you have to flip to the back of your booklet where I put all of the tables and charts. And I think the very first one is the one that we want this time. Let's see. L10. There it is. Yep. Table 4 it's called. And it is the tenants, which again means, just means renters. Package policy. And okay, see, this is how good my memory is. I already forgot what we did here. Comprehensive plan for $25,000. Okay, so a comprehensive plan for $25,000. So notice that my screen just froze. There we go. We're back. Notice that it says all areas of Manitoba. That means it doesn't matter if this apartment building is in downtown Winnipeg or in some smaller town somewhere. So that's not going to be true of houses. You're going to see where it matters where in Manitoba you are. For renters, it's anywhere in Manitoba, and these tables are always designed for a $500 deductible. If you're not sure what a deductible is, we'll talk about that a little later on. But anyway, let's follow the instructions again. It says comprehensive plan, $500 deductible. So everything in this chart's a $500 deductible. And he wants comprehensive, which is this column here. Notice that's more expensive than that column, and you'll see why in a minute. And he has $25,000 worth of stuff, so that's the first number on the chart. I'm bad at looking at these without a ruler, so I'm going to use a ruler. So there we go. It's the $200. That's it. $200. There's no calculations involved. You just have to look it up from a chart. There's the easiest mark you're ever going to get from me in this course. So that's it for example 1. That's all you have to do. Now, let's use the space here and actually do a little bit of notes and talk about what some of these things mean. First of all, what is the difference? What does it mean, the difference between standard form insurance or comprehensive form insurance? Well, I'm going to write this small because I'm going to try to squeeze a lot into here. Standard form insurance, also sometimes called broad form, BROAD. The Americans especially call it that in their insurance industry. Broad form insurance covers you for loss or damage due to a set list of causes. And another word for those causes is perils. Perils are things that might pose a danger to your home or your property. And I'll finish that with your insurer, that's the company you buy insurance from, is not responsible for a loss from a cause not listed in your policy. And policy is another word for, I'll just define that up here. Policy is your contract. When you buy insurance, you actually are signing a contract. That's a legal document that will say what you are responsible to do, which is in most cases pay your bills, and what your insurer is responsible for in the case of you making a claim against your insurance because something bad happened to your property. It got damaged or lost or stolen, and it needs to be replaced without you suffering the financial loss. That is what the insurance company has to do. They have to pay for it. But notice standard form or broad form only protects you against a specific list of things. Now I'm going to just go to this cool webpage that I found. Not that one. That one. In the insurance industry, there is a kind of a standard list of things that broad policy or standard policy will protect you from. There is fire or lightning. Now, obviously, if you cause the fire yourself, that'll be explicitly stated in your policy that if you set the fire yourself, or it is proven that you started the fire in your house, your insurance is null and void. You can't burn down your own house and claim the insurance. That is fraud and arson, and you go to jail for that. So fire, of course, of not your fault's origin. It could be something like the electrical system in your house was bad, or your neighbor's house caught fire and it moved over into yours. Of course, the example we're talking about is tenants too, right? So the person next door to you could have been a careless smoker and caused a fire, or caused a fire cooking carelessly. So fire, and of course lightning can cause fires and cause damage as well. Explosion, most of the heating systems in this city are natural gas, and if a natural gas heater is neglected or faulty, it can explode. Electrical fire or electricity damage, smoke damage, falling objects like trees falling onto your house, impact by aircraft, spacecraft, or land vehicle. Land vehicle, of course, means cars. Now, this one's kind of interesting because this actually happened to my parents once. A vehicle did slide off the road and into their house, and it didn't actually take a claim against my parents' own house insurance. It was a claim against the automobile insurance of the person driving the car. But if your house is damaged by anything crashing into it, your insurance, if not the people who insure the vehicle that crashed into you, will have to cover that in pretty much every case. Riot. If you lived, say that you had an apartment building downtown and you lived in a city where they won the Stanley Cup, and the celebration kind of turned a little bit into a riot, or worse, they were in Game 7 of the Stanley Cup and lost, which is what happened to Vancouver a few years ago. Well, lots of people who own buildings had those buildings damaged in the riot. Their insurance will likely protect them from that. Vandalism or malicious acts. Just a couple years ago, we had some drunk walking down the street near our house in our quiet little neighborhood who did all kinds of damage to parked cars and other things, including he threw a brick through the window of my house. My house insurance covered that, and we had to not only replace the window, but we also had to replace the hardwood floors because the brick that he threw caused a big gouge in the floor. So my insurance policy paid for all that. Sudden and accidental water escapage or rupture. Now, this, I got this website, I think it's American. This one is a little bit tricky. Sudden and accidental water escape, not everyone's insurance will actually cover that. Here in Winnipeg, I know one of the things, I actually have a map of Winnipeg here. Those of you who are fairly new to Winnipeg, maybe you even moved here this year, maybe the first thing you noticed about Manitoba is, man, is it flat. The one natural disaster that happens in Manitoba more than most places in the world is flooding. And when we say things like sudden accidental water escape or rupture, we don't mean water escaping from your sewer in the basement and flooding your house. Or again, if it's an apartment building, water escaping from below the building and filling up the bottom floor or the main floor where your apartment might be. Those things are special, and some insurers cover them and some don't. In fact, Manitoba and Canada overall was one of the last Western countries. It was, I think, the last G7 country that had an insurance, that had the insurance industry cover people in case of flood. Most people couldn't get flood insurance in Canada anywhere till I think about 2015. I actually found a news article about it. We'll go look at it in a minute. And there's still some parts of Manitoba where it's very, very difficult to get flood insurance because we flood so frequently. It's too much of a risk for insurance companies to take. Remember, insurance companies are businesses. They're there to make money. So if they have to constantly pay out because floods happen over and over again, they're just going to say, we don't want to offer flood insurance. So when we say, in this case, sudden and accidental water escapage or rupture, I think we're talking more about the plumbing inside your house suddenly breaks, floods your house. Now you have yourself damage that you have to have paid for. Your home insurance should cover that. Wind, storm, or hail. Hail is another type of insurance that not... Oh, look at that. I could go to Twitter. Hail is another type of insurance. Everybody knows what hail is, right? When you have ice crystals or ice rocks falling from the sky in a bad thunderstorm. Some insurers don't cover that, especially again here in Manitoba where we have hailstorms fairly often. Windstorm insurance, if you live further south but in the same sort of center of North America like us, you're more in Tornado Alley as they call it, you cannot get insurance against wind damage in most of the central United States. Transportation protection, and this is interesting. What they mean by this is that if you move, say you sell your house or you get out of your apartment and you move from one place to another, if your possessions are damaged in transit, say that you rent a moving vehicle and it gets into an accident and some of your stuff gets damaged, that actually happened to somebody I know, your home insurance actually is will compensate you for that loss. And then, of course, this is maybe the most important one for those of us here living in the city in modern times, theft, and that includes damage caused by attempted theft. Not, like, for example, if they break down doors and windows to break into your house and steal stuff, your insurance will cover the cost of paying for that too. So, I didn't want to list all those things in this little space we have here, as you can see, but any policy that is a standard policy will list all of the things. And again, some policies might not have windstorm or hail. Some of them might not have water or flooding of any kind. So, I think they'd all have most of these things listed. The contract you sign when you buy insurance for home or your apartment is pretty big, and you really should read. I mean, that's good advice. You read everything before you sign it. But read through it and you'll see all of the things that you are covered for. All of these things, again, are called perils. So that's standard form. Comprehensive is also sometimes called all perils, and it's kind of the opposite of this. It covers you, let me underline that, all perils. It covers you for loss for any reason except any cause listed in the policy. And of course, because it covers you for more things, it is more expensive. I'm going to give you a ridiculous suppose. Suppose you lived close to the zoo, and I know our zoo, the Assiniboine Zoo, doesn't have elephants, but let's say they got some elephants. So you live close to the zoo, and a zookeeper, by neglect, forgets to lock the cage one night, the enclosure. The elephants escape the zoo. They somehow cross Broadland Boulevard into your yard and trample your property and cause a whole bunch of damage to your home. Wild elephants cause damage to your home. Well, let's see. If you had standard insurance, let's see. Nope. Doesn't look like you're covered for elephant stompings. Not on the list. But if you had comprehensive insurance, it'd be like, let's look at the list of things I'm not insured for. And guess what? Elephants isn't on it. So your insurance company will have to pay for it. Now, most of the things that can damage your house are on this list. It's pretty weird for, I mean, what are the odds? I guess the odds of elephants trampling your house are very, very low. They're not zero, but they're very, very low. There are commercials that you'll see on TV where, I think it's Farmers Insurance, an insurance company in the United States. The guy who plays J. Jonah Jameson in the Spider-Man movies is their spokesperson. And they have all these crazy situations that cause damage to homes, and he's showing them off in a museum like, yep, we covered that. I guarantee you that they covered that, as they boast, only if the kind of coverage the person had in the case was comprehensive or all perils. Standard form insurance only pays for the things on the list. Comprehensive pays for everything except what's on the list. This is a complicated idea, and I know there might be people thinking, what does this have to do with math? I'm not calculating anything. There's usually a question about this on the provincial exam. I really like the way this webpage, I'm going to show you this webpage, explains this. And I keep picking the wrong page. This is it. No, this isn't it. Is this it? There it is. Yes, this is the one. Okay, I was on the right page in the first place. Should I get broad form or comprehensive? And they use the analogy, think about it like buying a pizza. If you say one regular pepperoni, please, broad home insurance is like ordering a regular pepperoni pizza. You know exactly what you're paying for. There's a list of ingredients. Yep, we got cheese, we got sauce, we got pepperoni. But if you are worried that, it's missing some of the things you want, you're worried about that stampede of elements, you're worried about perhaps damage from insects, you're worried about damage from something that's not listed in their basic policy, you would want the comprehensive. And that's like going into the pizza place and saying, I want the works. I want a pizza with everything. If I say the works, I'd have to look at the restaurant's menu. They might have a little clause on the menu that says, when you order the works, we won't put caviar on it. That's available at a separate special price. That's like comprehensive insurance. They might have some things that they've listed that won't be included, but everything else they've got will. So the ingredients matters, as it says. So I really like that analogy. I think that helps me understand it. Somebody usually asks when I'm doing this little lesson, and again, I really wish we could be in class and be having a discussion here instead of just me talking to the void. But what if you have one thing in your home or your apartment that's really expensive? Like, say you have an art collection. Say you have a friend of mine had a hockey card and a baseball card collection that was worth hundreds of thousands of dollars. Your home insurance won't pay for something like that specifically. That's what's called a rider. That's where you get a specific insurance on one's collection of items in your house. So I know I've had students on the provincial exam who get this question about, hey, can you explain the difference between standard and comprehensive? And I think sometimes teachers who teach math and teach this course, they don't know anything about insurance, and they just assume, oh, well, comprehensive would cover everything, even if you had an expensive art collection that burned down. No, it wouldn't. The amount of money that they'll pay you for the damage in your house is just capped at how much your policy's worth. If you have one or two or a collection of things that's super expensive that you want to insure separately, you need a rider for that. So I'm going to even write down not the same as a rider, which is specific insurance. Oops, and I just misspelled insurance. Specific insurance for special items. Another thing, riders don't have to be for specific items, so they can be for specific events. If you have a bigger piece of property and suddenly you wanted to host a wedding on it, and you're going to have 400 guests on your property, you might want to go to your insurance company and say, you know what, I need a rider in case something bad happens at this wedding. I don't want them suing me in my homeowner's insurance because somebody got injured during this party with 400 people at my house. You can get a special rider, a special event insurance, just like a special item insurance. Okay, so that's the basics of the types of insurance you buy, and that's true for tenants, or again, it's standard and comprehensive. It's also true for homeowners, people who own houses. And again, homeowners insurance protects homeowners and condominium owners from fire, burglary, storm damage, etc. And again, those are the perils. It covers the contents, the building, and the liability. Liability is how liable you are if somebody might want to sue you because something bad happened to them on your property. Deductibles are between $200 and $500, and those are the only two that we're going to calculate with. And premiums increase based on number of claims. So that actually kind of already answers a couple of the questions here. What are the factors affecting cost? Well, the first factor that affects cost is, like they say in real estate, location, location, location. There are 4 different location types here in Manitoba. There is Zone 1, which we call, or actually I think it's not zone, I think it's Area 1. They're areas, not zones. Don't worry about it. Area 1, which is what we call Metro Winnipeg. And again, I've had many students over the years, if this pops up on the exam, answer this wrong. They hear the word metro and assume that means downtown. Oh yeah, you live in downtown Winnipeg. Nope. Winnipeg is defined as anything within the city limits of Winnipeg. And here's the map of Winnipeg. And that red line there is the city limits of Winnipeg. But actually, that line there doesn't define Metro Winnipeg for insurance purposes. If you've never really looked at a map of Winnipeg, we are here. Fort Richmond is down here. And can you see this really skinny blue line? I'll zoom in on it. Oops, there we go. That skinny blue line is what we call the Red River Floodway. And again, here's Fort Richmond Collegiate, right where we are, right here. And notice that is north of the Red River Floodway. And that actually is the technical definition of Metro Winnipeg for insurance purposes. It means that you live in Winnipeg, you're within this red zone here, and you are north of this blue line. Because the blue line protects all of the city of Winnipeg from flooding. When the river gets high, they open the gates to the Red River Floodway, and a whole lot of the water goes slooshing all the way around the city and back into the Red River up at this north end, past the city, and then up into Lake Winnipeg. Right there. So that is what it means by Metro Winnipeg. You live protected from flooding inside the city. The other thing that they care about by making insurance prices different for people who live in the city is, of course, if you live in the city, you are never more than a few minutes away from a fire department. And Metro Winnipeg, of course, means that you live in the city, inside the floodway, and a fire department could respond to an emergency at your home in minutes. In Area 2, you're not protected by the floodway. You might be down here, you might be up here, but you're still reasonably close to, or you're in a town. That's the way I think about it. Area 2 is in a town. And what makes a town have its own category is that, once again, there's going to be a fire department. It may not be as big as a city fire department. It might take them a little longer to get there, but you still have a fire department. You also likely have a reasonable distance from your property to a fire hydrant. You still live in a big enough community or in an area where there is still underground plumbing, so that there's a fire hydrant that the fire department can actually connect to put out a fire on your property. So if you're in Area 2, there's a fire department, likely even fire hydrants near your property. In Area 3, you might not have an actual professional fire department. You may just have a volunteer one. And you might be not close enough to a town to have a fire hydrant. You might be on a farm. So you are rural. So this is, of course, city, town, and this would be more what you call rural. And then Area 4, you're even more remote than that. You might be, as they say, out in the boonies. You might be a cabin in the woods. You are not likely reachable. Not reachable by fire department. That's a DEPT, which is shorthand for department. So that's the 4 areas that they calculate insurance prices based on. Oh, hang on. Sorry, I left the picture on the map. I'm sorry. My bad. So there we go. Area 2 in a town. Area 3 is on a farm or somewhere close enough that at least a volunteer fire department will get to you, but it might take a while. We call that rural. And then, of course, there's remote. You live out in the forest or on a farm so far away that even a fire department isn't going to get to, or a volunteer fire department won't get to you within time before a building that's on fire in your property will burn to the ground. So there we go. Location is the first and probably major factor affecting cost of insurance, but there's others. There is, of course, your neighborhood crime rate. Right? It's more expensive to get insurance in a neighborhood that has lots of crime than in a neighborhood that has little. Yet that's up to your insurer to decide whether you're a bigger risk for living in a high crime neighborhood. Other fire safeguards in your house. Right? Do you have sprinklers built into your house? Do you have fire extinguishers? Do you have a fire alarm? Okay? Those things actually reduce your insurance costs. Then, what's your house made of? Materials, condition, and age of your home. Right? Older houses have a tendency to have a higher risk of fire than newer ones. I think you've probably, if you've watched local television, seen the ads from, I think it's Mr. Electric, who warn you that if you have a house built in the 50s or 60s, you might have aluminum wiring in your house instead of copper. Aluminum wiring gets hot. It can, as it gets older and the insulation around the wires wears off and rots away, it leaves your house at risk for an electrical fire. So age and condition and materials that your house is built out of affect insurance. If your house has vinyl siding on the outside instead of stucco, that might affect the policy rate that you're paying for. That might affect your premium rate, because fire departments have to keep their distance. If your house is on fire, it takes them longer to put out the fire. You are at a bigger risk of your house burning to the ground versus being saved if you put vinyl siding on your house. Even though it looks nice, it's low maintenance and it's cheap. Something to think about. Have you made any previous claims? Oops, I meant claims, not clams. They don't care if you eat clams. Claims. So, previous claims, what does that mean? Well, I think I told you a few minutes ago, right, that We had to put in a claim because somebody decided to, in a drunken stupor, to throw a brick through our window. Then the next year, when we looked at our insurance policy, it started to cost us more for insurance by a little bit because we'd made a big claim the year before. That's the way it is. If you have to make a claim, your insurance cost will go up afterwards. This one's important too, your credit history. Do you pay your bills on time? Have you paid your credit cards on time, paid your mortgage on time? If you have fallen behind and been late on payments and things like that, they will consider you a risk of paying your insurance bills as well, so they will not, that'll factor into their calculations, and they'll charge you more for insurance. And then the last and second most important one after location is, what is your deductible? And if you've never heard that word before, and again, if you've done insurance in the grade 11 essential course, you've seen this before. But deductible means amount you pay to make a claim. So most people have a $500 deductible. So if you have to make a claim, something broke in my house, somebody stole stuff from my house, usually you have to pay that $500 deductible. If you want a $200 deductible, so it's cheaper for you to make a claim, you're going to have to pay more for that in insurance. So let's do a couple of examples that take all this into consideration. All right, let me move that out of the way. Example 2. Pierre and Susie have purchased a home with a replacement cost of $175,000 in Winnipeg. They wish to purchase standard coverage with a $500 deductible, calculate their annual premium. That's actually kind of a wrong question to ask, because you know what? You don't have to calculate anything. You just have to look it up. So go back to the table. And, okay, so, not this table. Don't go back to that table. Go to the table right after it. So let's see. There it is. Manitoba home insurers rates. Okay, so what did we want again? We wanted Susie and Pierre living in Winnipeg, so Metro Winnipeg. So they're in these two columns. Do they want standard or do they want comprehensive? They're paying for standard. And again, notice the numbers are cheaper in standard because it doesn't cover as much. $500 deductible. So everything on this chart is a $500 deductible. If you want to pay the $200 deductible, you have to increase every payment on here by 10%. I'll show you how to do that in a minute. So they are going to pay $175,000. Once again, I need my ruler. $175,000 standard in Winnipeg, $607. So that's it. That's all you have to do, $607. You know what? To make life a little more interesting, I'm going to call that A. And then for part B, I'm going to say, what if they wanted a $200 deductible? And again, what's deductible? I'm trying to talk and write at the same time. Question mark. What's the advantage of that for them? Why would you want a $200? Well, in other words, if you have to make a claim, instead of paying $500 to do it, you only pay $200. But your insurance is more expensive. In fact, let's see. How do I do this again? It says increase your premium by 10%. So their premium is $607. How do you mathematically increase a number by 10%? Well, you can take 10% of this number and then add it to this number. I find that inefficient. Why don't I just find 110% of this number, which is 1.1 times this number? And let's do that calculation. Finally, we're a half an hour into a math lesson and we're finally doing a calculation. 1.1 times $607. Boom! $667.70. So I ask you, if you are Pierre or Susie, is it worth an extra $60.70 every year on the chance that you have to put in an insurance claim to save $300? I don't know. That's the risk you want to take, I guess. Example 3. Now we're back to Pierre and Susie. They've moved up in the world. They've bought a $375,000 house, but they're not inside Winnipeg. They're outside in the perimeter. They wanted a big yard to let the dogs run, and Pierre has a snowmobile. Susie wants to keep a garden. You know how it goes. So Pierre and Susie are outside the city. They are in Area 2, and it says that they have a $375,000 house. So they're in Area 2. They still want standard. They don't want the comprehensive. I guess their standard includes flooding, so they're good. So, but, oh, see the problem? They have a $375 worth home, and that includes how much they think the stuff in it's worth too. But this only goes to $200,000. So look what it says there. Additional amounts per $1,000 of coverage, you add $275. So, first of all, the up to $200,000 is $519 a year. That's, everybody see where I got that number? In standard Area 2. Okay, so it's $519 per year, plus it's $2.75 times, and let me show you again, for every additional $1,000 of coverage. So how many thousands above 200,000 is 375? All right, I'll do that as a side calculation. $275,000, or sorry, $375,000 minus the $200,000 is $175,000. Now, how many thousands is that? Right, it's 175 of them. So that's the number that goes there. So for every 1,000 above 200,000, in which case for them it's 175 of them, they pay $2.75. My calculator knows to do multiply before add because it knows bed math, so I'll just do this all as one calculation. 519 plus 275 times 175, boom, is $1,000.25 they pay every year for their home insurance. Okay. There's a couple other things I was going to show you. Again, I found an actual article here that talks about, here you go. This is what life could be like. This is just south of the city back in 2011. There we go. It's right there. When the last time the Red River flooded pretty bad and people had to, of course, sandbag and try to protect their homes from flooding. People in this part of Manitoba, which isn't very far from us, were not able to get flood insurance until just 2019, just last year. So, and like I said, we were the last G7 country to get flood insurance, and that didn't really happen in Manitoba until 2016. So that would be something that it would say, even if you had a comprehensive policy, it's like, we will not cover you in case of flood. So I just wanted to show you that. And the other thing, of course, is, here's Winnipeg. And remember, Manitoba is a big place, right? So if you are in Winnipeg, that's Zone 1. If you're in these kind of smaller towns, you're in Area 2. If you're in the farm areas between those towns, you're in Area 3. And if you're, say, in the forest, or you're way a long way into the farm country, too far from any of these bigger towns, you are in Area 4. And that's the way to think about it. Okay, I'll put links to these two kind of articles, things that affect homeowners insurance and the difference between comprehensive and standard. I'll put links to those into the blog update. And you are now able to do assignment 6, but I'm going to just, whoops, let me show you assignment 6. There we go. You're able to do assignment 6, but don't worry about question 6. That's the kind of thing we do if we had a full class together and we could do a discussion. Can you do the calculation questions is the important part, and look up things properly from the chart. It's not a lot of homework, and this will be the last assignment we do this week until Tuesday. Enjoy your long weekend, everybody.